Hello, everyone, and welcome to another episode of the Professionals Pulse. I'm Farida Musaddi, the co founder and CEO of Alphateh Technologies Dubai. Well, today we're going to talk about a very crucial topic for business owners, investors, and entrepreneurs alike, which is equity versus debt financing. Which investment is the model that is right for you? Now, nowadays, with Shark Tank being so popular, we often hear about these terms about equity, debt financing. We need to understand what these terms are and which model fits well. In today's financial landscape, choosing the right method to find your business growth is very much essential. Whether you're looking out to raise capital, to scale your business, or launch a new project, or maybe sustain operations, the decision between equity and debt financing can have a significant impact on your company's future. In this episode, we are going to explore the key differences between these two financing models, their pros and cons, and help you understand which model best aligns with your business goals and risk tolerance. And joining us today with us is Mr. Piyush Munot. Hello, Mr. Piyush. Welcome to the
Hi,
Professionals Pulse.
hi, Farida. Thank you so much for having me. Pleasure.
So, Mr. Piyush is a second generation UAE resident with over 20 years of experience in various financial domains, which includes M&A consulting, private equity, asset management, fundraising, and family office management. He currently owns key positions as a shareholder and director at multiple investment firms, including Fiora Global Investments, uh, Blue Sky Capital Fund, Beyond Beta Capital Fund, ArcLinks, Aqua Creek Consultancy, and BB Dynamics. These firms focus on global investments, wealth management, and M&A advisory. Previously, Mr. Piyush was a partner at Greenback Capital and has worked with MSSN Capital managing diverse asset classes. He also led a portfolio at Al Dahra Holding, a food and agriculture focused sovereign wealth fund, and has over 10 years of experience with KPMG and PwC in business valuations, M&A, and audit. Mr. Piyush also holds a bachelor's in commerce and is a member of the American Institute of Certified Public Accountants. He also has an executive MBA from the Indian Institute of Management, Ahmedabad. Once again, Mr. Piyush, welcome, and we are really happy to have you here on the Professionals Pulse.
Thank you so much. It's a pleasure.
And I think what we're going to talk about today is a topic which I guess many people would, be interested in or align with, because nowadays every business at some point of time needs uh, fundraising, needs investment. And this is a very important and crucial question, whether to go for equity or whether you should go for debt. Both of them, I know, have their pros and cons, and we would love to hear it from an expert like you as to which would suit a particular business model. So,
All right. Actually, let me just
yeah.
start by explaining some of our viewers, those who don't really know the difference between equity and debt. Equity is basically when you put your own money into a business or a project, or you convince anybody else to partner with you and invest in the project or a business. Debt is when you don't have your own money or do not wish to invest your own money. You try and approach a professional organization that is in the business of lending and then ask them to invest money on your behalf. And what do you
Okay.
do in return? You pay them a fixed interest rate or a floating interest rate. So that, in a nutshell, that's really the difference between equity and debt. Actually, when you put your own money, that's equity. You borrow somebody else's money, that's debt.
Correct. So, how does a company stage, whether it's a startup or an established company, impact this decision of going for equity or debt financing?
It's a really good question. Typically for an entrepreneur, it's always a catch-22 situation.
True.
While it's very convenient to borrow money from somebody else and pay them a fixed interest rate, it requires a lot of courage and a lot of aspiration and a lot of strong signal that the business that you're actually investing in will really reap you good benefits. So
True.
while there's really no fixed tailored solution to what fits all, the ideal thing I'd say is for any entrepreneur to assess what life cycle of business they're in. If they're in a
Correct.
business that is generating steady profits and they can accurately forecast the next 2 or 3 years, they accurately forecast the ability and the willingness to repay a bank, then by all means go ahead and borrow. But
Okay.
if you're not certain about the future, if it's a brand new project, if it's a startup, especially with all the budding entrepreneurs and startups and ventures out there, stay away from debt. It's my
Okay.
thumb rule advice. Put your own money. If you can't put your own money, stay out of that business.
True. That's true. So, what are the biggest risk factors, which founders face when they are giving up their equity, and how can they protect their control over the business? Because many a times, people are scared to share equity. They feel that they will lose the power of decision making. So, how true is that, and what are the risks that one should look out for?
Yeah, I think this whole concept of control uh, is a myth and something of the past, I'd say. For
Okay.
example, if it makes business sense, you have to first, before you think about how much control you have, whether you take up debt or you invest via equity has to make business sense. Can the business repay? If it can, by all means, go ahead and take debt. It is cheaper. If you don't know what's going to happen with the money, stay away from debt. That is a thumb rule. Now, as
Okay.
far as control is concerned, if you borrow money from somebody else, you don't lose control. But if you don't repay that money, they will start to control you. Try not paying back a bank. The bank will come and they will stick their hands into not just your business assets, but also your personal assets at some point.
Absolutely,
So,
yes.
this whole concept of control, I think now has become a bit of a myth.
Okay.
And I'll also, even with equity, people, a lot of times, when you have multiple investors in a company, the individual or the company with the largest shareholding in a business often assumes that they're in control of the business.
Yeah.
Control you is always with the people that actually run the show. There's I'll give you an example. If you look at the Tata Group, it's a very large business conglomerate in India. And if you look at the
Absolutely.
shareholding that Ratan Tata himself had within Tata Sons, and Tata Sons is the holding company of all the businesses, was
Yeah.
less than 10%. With less than 10% in Tata Sons, he had management control.
Correct.
So where is the question of shareholding now? So control, I think, is more it's sort of a decoy of the mind, and whoever runs the business actually controls the business. It's not always about shareholding.
Okay. All right. But then, this is like one of the examples. But then, otherwise, don't you think? Because if an investor comes in, okay, they might come up with a small bit of an equity. But then, many a times, if it goes in this way that they are the ones who are actually putting in money, so things should be going according to them. The flow of the business, the kind of things that you take up, everything should be controlled by them or should be in their monitoring. Wouldn't that also be one of the potential risks involved? And in that case, an individual or an entrepreneur does not get that free hand, to do things in their way. Does that also happen?
That's quite common actually, especially in businesses that are more conventional. Typically, you typically find that the the investor tries to somewhere throw their weight around and try to exercise control. But as an investor, you got to understand that, to win a horse race, it's the jockey, right? It's not the owner of the horse. If the jockey isn't right, then no matter how expensive the horse is, you're not going to win the horse race. So you
Correct.
really need to bet your money on the right professional to run the show. Tomorrow, if you don't back the right investor, or don't back the right individual to run a business, this individual may go away, find somebody else, and can run a parallel business.
Correct.
So, this whole concept of, because I am the guy who's put in the money and therefore I should have the last word. In work does work, and it's very, very common, especially in this part of the world, but it's changing. If you try move to the west, the emphasis on technology and the emphasis on strong professionals is far greater.
Okay. And at what point, just as an extension to this question, maybe there are startups who might need investors at an initial time. And then when they scale up, so is it advisable to get the investor out and continue on your own, or that investor or the person should stay, get more investors? How does that go?
Well, that's there's really no yes or no answer to that question. It really depends on what each shareholder is contributing to a company.
Correct.
If you move forward and if you're the gentleman running the show, and 5 years from the time that you start a business, you feel that the other investors are not contributing, I think it's worthwhile having that chat with them that, listen, guys, are you really interested or not interested? If the
Correct.
business has the ability to pay back some of these guys, by all means, go ahead and do this.
Correct.
But if these shareholders are contributing, then you only discuss growth plans with them. So it's difficult to, there's really no yes or no answer. But every shareholder must contribute. Either you put in the hours, or you put in the money, or you put in both. Or you bring in the connections, you expand business. But every shareholder must have a clearly defined role on day one. Otherwise, partnerships will typically not survive too long.
And investors also often ask that a business needs to have a co-founder. Why is that important?
Um, because as a founder, it's difficult for a professional to have all the qualities to run a business. That does happen many a times. I'm not denying that somebody may not have the ability, but it's always good to have a co-founder, one that can look into the business, and the other who can really look outside and try and bring business. You split the responsibilities between you
Correct.
so that the business can grow at the end of the day.
True.
So it is, many businesses do encourage having a co-founder, especially the ones that are tech driven.
Correct.
You will typically see that one of the two shareholders will be a techie, and the one who will be controlling the technology part of a business. And more often than not, that person will be the co-founder.
True. That's true. Coming to debt financing. So, debt financing allows, of course, businesses to retain their ownership. But again, what are the hidden risks there also? I know you talked about banks, that one potential risk where a bank can get into your personal assets also. But then there are also people who take debts from personal contacts, or some third party people. So how does debt financing work, and what are the risk factors involved there as well?
Yeah, for a lot of finance professionals watching this will not agree with me, because when you study finance, you study that debt always comes cheaper than equity. That if I go borrow money from a bank, they'll probably lend the money to me at the cost that they borrow money plus their interest rate. Whereas
Correct.
if I go seeking money from an individual investor or an institution, the expectation of return in the mind of the individual or the institution will be much higher than what a bank will ask me in terms of interest rate.
Correct.
While that is a thumb rule, but I think it's something that exists only, in textbooks. I'll give you a small example. Imagine three or four of your friends back from your university or school days, and a couple of them kept borrowing money from you, while the third one never borrowed any money. Now, whom would you be more comfortable lending money to? The ones who are always in debt or the ones who are never in debt? And the answer is quite obvious. That so and if any of these individuals had to start a business, your comfort level would be way more with the person that was not borrowing. So
Correct.
what excessive borrowing does is it increases the expectation of return in the mind of the equity shareholder, which means if I lend money to the United States government, my expectation of return would be much lower than if I was to lend money uh, to any other nation in the world. Actually, let's take
Mm-hmm.
India for example. So, in the borrowing cost that India would pay to the international world would be higher than the borrowing cost that the United States would pay, simply because the the perception in the world is that they're a much larger economy.
True.
But if this debt doesn't go well, or if in a growing business, if debt works well, you're happy you can repay, then it's fantastic. But in a situation where you can't repay,
Mm-hmm.
uh, debt can be really lethal, because you borrow money from a bank, you have to repay them. You may not
That's
repay the equity shareholders. If a bunch of people come together and start a business, and if the business fails, they just don't get their money back. But if
correct.
they've put in money and they've borrowed from a bank, and if the
They have.
business isn't doing well, regardless of what happens, you've still got to repay the bank, or the bank's going to come after you no matter where you are in the world. So it's a
Correct.
huge risk. It's a huge risk. Yes, debt is cheaper on the face of it, but the higher the debt, the higher the expectation of return in the mind of the equity shareholder.
Correct.
So, I leave the decision to the people following this, or the individual founders. But generally, my thumb rule is, as far as possible, stay away from debt.
There are certain private investors who also offer debt in place of equity. So, if a person does not go to the bank but goes to a private investor for debt financing, is it better than going to the bank or is it equally worse?
Well, there are two things to this. A bank usually conducts very detailed due diligence before they lend any money.
Absolutely.
As an individual, high net worth individual, the speed at which money can be dispersed is much faster. So there's an advantage.
Correct.
However, the interest rate that the individual will charge you will be higher than the rate that the bank will charge you.
That's true. That's for
So,
sure.
so you're actually at a crossroad where on one side you can borrow cheaper, but it'll just take longer for a bank to disburse money. On the other side, you can borrow quicker, but at a higher interest rate. But also depends on what kind of business and for what purpose you're actually borrowing. If you're borrowing to increase your business, and if you're borrowing to, let's say, start up a new factory, my advice would be to go to a bank, give them a proper feasibility study, explain to them what the factory is going to do, how you're going to repay the money back.
Okay.
But in where individual financing comes in handy, are a lot of trade financing situations, actually, where people buy and sell commodities across the world, where perhaps you may have confirmed orders from, let's say, Germany to buy raw material from Europe. This is when individual lending comes in play, and they can often bring in the sort of bridge capital and ensure that the trade is complete at a higher rate of interest or a margin of the profit.
Okay. Correct.
Yeah. Like banks are not going to ask you margin of profit, actually. Banks will expect their fixed interest rate. Could be
Fixed
low, could be
interest.
high,
Yes.
could be negotiated.
Correct.
So that's so it really depends on what life cycle of business you're in and what business you're actually in.
True.
Don't borrow money to pay dividends. Dividends should be generated from the business itself. If the business hasn't made money, you can't borrow from a bank and pay back your shareholders. I think is criminal. But I've
Correct.
seen that in cases here, but I think that it's not even ethical to say the least.
Absolutely. That's true. That's true. Um, so how have the recent economic shifts, like the rising interest rates or the market downturns, influenced the choice between these two different models of financing?
This also varies by what kind of debt you're actually borrowing. So, just for the sake of all our viewers, let me explain that a business overdraft is also debt.
Yeah.
A car loan is also debt. A credit card is also debt. Home loan is debt. Personal loan is also debt. These are all forms of debt, actually.
Correct.
Now, look at the average homeowner who's looking to borrow money and buy a house. In a scenario of rising interest rate, he's not going to be encouraged to buy a house because the interest rate that he's paying the bank or whichever lending institution is way higher than what it used to be. Or
True.
if you're thinking of buying a car or buying a motorcycle or uh, uh, spending money on any sort of consumer goods, the scenario of rising interest rates is not a very happy scenario. You'll end up shelling more money to buy the same product than what you could have in a scenario of lower interest rates.
That's true.
But in scenarios of business, actually, and business scenarios don't move in the same direction as economic cycles, right? You could have started a business at a time when interest rates were high.
Yeah.
Does that mean you're not going to borrow? No, of course you'll borrow. If you need to borrow, you will borrow.
Correct.
So, the scenario of rising interest rates has okay, and this also has a trickle effect actually. Rising interest rate means less money more money in the hands of banks, less money in the hands of the businessmen or the individuals. But it also affects gold prices, affects the inflation, it affects the country's ability to borrow or lend. So it's got a trickle effect globally,
Correct.
which is why usually everybody is glued to what the Fed's going to do. So the United States Federal Reserve is the primary organization that actually hikes or decreases in interest rate. So you'll see
Okay.
typically that has a sort of very trickling effect on every country in the world and every commodity of the world as well.
Correct. Because in a country like India, I think, as you mentioned, uh, from housing loans to personal loans, I think that's quite prevalent out there, for appliances to houses to cars to everything. Easy loan facilities are available, so I think people are more um, attracted towards buying those properties on EMI, long term EMI. I know people pay around 40 years of EMI to buy that one property of house. But mostly in Western countries, that idea is not really prevalent. So I think that also has a very major effect on how the population or the culture of that country thinks in that way, apart from the interest rate and this, which is true. If a person has to borrow, then no matter what the scenario, what the interest rate, you will be going in for that kind of financing model. And I think also, one factor is that sometimes if you are not connected with the right kind of investors, or people do not get that opportunity from investors, then the only place to turn to is banks. So that is where people end up going to borrow the money if they do not get investment firms who are really interested in their product or in their business.
Correct. The
Um,
bank doesn't care about, is not sentimental about your business. The bank only cares about how much money they can make on their money. But
Absolutely,
the
that's true.
people that partner with you in a business are should or ideally are equally sentimental about the business and are all looking to work towards the same objective in the long term.
That's true. That's true.
Yeah. But also
Do
look at
you
it this
also?
way, in
Yeah,
2008, the 2008 financial crisis would have never happened if people hadn't borrowed.
correct.
So the the crisis had catastrophic effects in the western parts of the world compared to a country like India, because India is still a very equity dominated country. People think long and hard before they borrow money,
Correct.
which is really not the case in western parts of the world. Therefore, they were more severely affected.
True. But do you think that every business at some point or the other needs financing or needs investment?
I would assume so.
Okay.
I can't really pinpoint on any particular business, but I don't think any business could grow without investment.
All right.
Investment can come as a part of not pocketing the profits that the business have generated and then redeploying the money back into a business and helping it grow, which is also investment in a way, or
Correct.
borrowing money from a bank or any other financial institution in order to grow. But if you look at a business and if you need to grow, you'll need to hire more people. You need larger office premises. Your office expenses will increase. Your direct costs will increase. I just don't see that happening without any investment. Actually,
So, from your experience, what kind of organizations generally come? They come at the startup level, or they come at a level where they have already started business, established something, and then they are looking out towards expansion. What is the more ratio
uh,
towards?
yeah. See, in a business that is capital intensive, will require constant investment. Actually,
That's
so
true.
if you're, let's say, in a pure tech business, then the only money that you'll invest is to enhance the tech, actually. So either you will hire more people to enhance the technology,
Correct.
but if you're in a capital intensive business where you need to buy product and then either sell the product or set up a large industrial unit, you need more financing actually. So
Correct.
typically, startups in the first couple of years, which is why they're called angel investors, right? They're all angels, families, friends who put in money. So, but if I was a startup entrepreneur, I would just stay away from any kind of debt for the first 2 3 years of a business.
That's
Thereafter, I'll give you an example. There is a form of financing which is very common. It's actually sort of a hybrid model between equity and debt, where
yeah.
raising money via convertible debt, these days is a very prevalent form uh, of raising capital, where the option then rests in the hand of the founder, where you can either make a bullet repayment back to your investors or convert the money borrowed into equity shares at a discounted value.
Okay.
And when you exercise the option and whether you exercise the option really depends on how well you've done in your business during the course of this borrowing actually.
Okay.
So convertible debt or compulsorily convertible preference shares is a very, very common form of financing, especially in the startup world.
Okay. All right. So you borrow and then you convert it into company shares that you offer to the person who's invested.
So you borrow money for, let's say, 12 months to 18 months with a promise to either pay back with interest at the end of those 12 or 18 months with no interest payment monthly. So at
Okay.
the end of the end of those 12 to 18 months, you will pay back the entire principal plus interest back to the lender. Or if you think you want to lock in the lender in the business for a long term, or if you feel that the business doesn't have the ability to repay the money at the end of those 12 or 18 months, then you do usually exercise the option of converting the debt into equity.
Okay.
And once that happens, then there's obviously no fixed stipulation to repay. With debt, there's obviously a fixed stipulation to repay, and there's a cost of financing. But once that money is converted to equity, then the business doesn't really have to repay the money immediately. So
Okay.
convertible debt and compulsory convertible preference shares, very, very common form of financing.
Okay.
Uh, but founders need to be very careful as to whom they borrow from and what sort of uh, a duration they set.
Correct.
So
That's
that I think is key.
and this form of this hybrid approach is prevalent across the world, or there are certain countries where this is more followed.
It's across the world actually. It's
Okay.
across the world. So there are certain countries that don't have a concept of preference shares. In
Okay.
those cases, you just call it compulsory convertible debt.
Okay.
But in countries where you have preference shares, there are preference shares also used. But as a form of financing, it's prevalent all over the world.
Okay. All right.
Everybody, yeah.
If we go on the other side of the scenario as an investor, okay, uh, what is more beneficial for them? Would they be more interested in equity, or would they be more interested in debt financing?
If the equity investor believes in your business, believes in the founder, thinks you can really grow their money, they'll always bring in equity.
Okay.
But if the investor is really looking for a place to make a quick return on their
Quick
money,
money.
then debt is the option that they'd usually deploy. Also,
Okay.
sometimes secretly, an investor may give you debt and not put in equity, knowing very well that if the founder is not capable of running the business, but the business inherently is sitting on huge assets, in many cases could be land banks.
Okay.
Companies or individuals will deliberately lend instead of investing in equity because they know very well that the business was not going to be able to repay that money. And therefore, the only option left with the founder would be to liquidate the business.
The
And
assets. Yes.
thereby, this debt financier gets to stick their hands into the assets or the sort of intangible value of the business.
That's true.
It's pretty mean, it's unethical, but these kind of things
That's how
happen.
it
I've
is.
seen them.
That's true. Of course. Yes. So that brings us, towards the end of this, where I want to know that what are some other creative financing structures apart from the hybrid structure that we mentioned that balance the risk while maximizing the capital efficiency?
I think the important part is for a founder to determine how much they can repay every year. So if they borrow money for 5 years or 10 years, the duration that they set should really be very extremely well thought of and should only come out of a thorough diligence on how much you can repay and at what durations actually. So
Okay.
in terms of
What is the
a
average repayment time that
it
one gets?
depends. So if you're in a place like Dubai, if you're borrowing to buy real estate, the borrowing duration could go up to as high as 20 years.
Correct.
If you're setting up a new industrial plant or a factory somewhere, the typical duration is about 10 to 15 years, depending on what kind of plant, how soon could the plant be commissioned, how soon could the plant start to generate product, and for you to sell product, collect your money, and be able to repay. In many cases, the banks are willing to give the borrowers something called a moratorium period, which means for
Okay.
the first couple of years, while this factory is under construction, they really don't expect you to repay anything.
Okay. Okay.
So, what you end up choosing is really a function of what kind of business you're in, how much money you need, how much money can you really repay, what life cycle are you in early. If you're in the first few years of a business, has your business become stagnant? Are you a first generation, second generation entrepreneur? I mean, and the list is never ending, really.
Correct.
But I will reiterate, as far as possible, stay away from debt.
That's true. So, any parting advice that you would want to offer, or any key points for people who are looking out for financing that you would like to share with the people?
Um,
How to present, maybe, how to make your business sound lucrative for investors? What are the red flags that one should watch out for?
um, if you're looking for equity financing, make sure that the people investing with you have the same long-term vision about the business as you do, and aren't in it just for the short term. If you borrow money from a bank, make sure that the business cash flows are certain and that you in fact can repay. So if you're looking for debt, be very certain of whether you can repay and whether you have the willingness to repay. And if it's equity financing, make sure that the people that are actually putting in the equity are like-minded. So
That's
that's really my parting advice to anybody looking to raise debt or to raise any kind of financing, whether equity or debt, actually.
exactly. So it's very important to find the right kind of investor who's not here in your business for his own profit or for his own benefit, but is also having the same vision that you share towards growing the business, who is, who would be involved and who would be a value addition to the
Correct.
business, not in terms of just the finance or the investment part of it, but also bring in his own expertise, his own guidance to make your business grow.
Right. Absolutely.
Exactly. So, thank you so much, Mr. Piyush, for sharing all of these valuable insights and giving us your expert advice on all of these key points. I think a lot of doubts must have been cleared for people as to what is the difference, what are the pros and cons of each type of financing, and what should one look out for when approaching people at the right stage in their business for investments. So, thank you once again for joining us today on the Professionals Pulse.
Thank you so much for having me. I hope I was able to provide some value add to all the viewers watching. Thank you.
Absolutely. So, signing off, we hope that this episode has provided you with valuable insights to help guide you towards your financing decisions. Remember, as Mr. Piyush said, that the right investment model depends upon what are your business goals, what are your growth plans, and your risk appetite. So, take the time, weigh out all your options carefully. Until next time, keep investing wisely and stay tuned for more expert invites on the Professionals Pulse. Thank you once again. Have a nice day.
Thank you.